Welcome to Thoughts on the Market. I'm Matthew Hornbach, Global Head of Macro Strategy.
And I'm Michael Gapen, Morgan Stanley's Chief U.S. Economist.
Today, we're talking about the March Federal Open Market Committee meeting and the path for rates from here. It's Thursday, March 20th at 10 a.m. in New York. Mike, the Fed released a new set of projections yesterday. What do these say, and what did you learn from them?
Yeah, Matt, well, the Fed's forecasts actually now look a lot like our outlook for the U.S. economy. So they revised down their expectation of growth. They revised up their expectation for inflation. So it has a bit of a stagflation, slower growth, stickier inflation outlook, which is very much what we were thinking coming into this year. The Fed also, though, highlighted high policy uncertainty. They wrote down a forecast, but I'm not all that convinced that they have a lot of confidence in how things will evolve. So I think for me, really, the bigger story were their updated perceptions about uncertainty and risks to the outlook. So in December, if you remember, they told us, virtually everybody on the committee said, uncertainty around inflation is high and risk to inflation to the upside. They complemented that this week with the fact that uncertainty around growth in the labor market is high, but risk to growth is to the downside, the unemployment rate to the upside. So you have kind of competing risks here around the Fed's dual mandate. They've got upside risk to inflation, downside risk to growth. To me, that's kind of the really important message. It's hard to have confidence in a forecast right now, but I think that risk assessment is really interesting.
And with that in mind, and given all of the policy uncertainty that the Fed mentioned, what did Powell say about how the Fed should react? In other words, what is appropriate policy at this stage?
Right. Yeah, it's tricky, right? So on one side of your mandate, you think risks to inflation are squarely to the upside and growth in labor markets to the downside. So what do you do? And I think Powell said, I think the logical answer, which is, well, right now you do nothing and you wait. But then I think what Powell said is, how we think this plays out is tariffs may boost inflation in the short run, which we're going to try to ignore. And if the economy does weaken and the labor market softens, we'll ease policy in order to support activity, right? So there might be, say, symmetric risks around their dual mandate, but there's asymmetry in the policy outlook. He said, we're either going to be on hold or we're going to be cutting rates. And generally, I think that's the right thing.
So, Mike, what I heard from you was that the Fed was going to look through inflation in the near term and then eventually cut. I mean, do you think they can do that?
Yeah, I think, Matt, that's a great question. My answer to that is, I think it's easier said than done. We agree that the next move from the Fed is going to be a cut, but we think that cut comes much later. This is a very data-dependent Fed. So I think in the moment, if tariffs boost inflation now and weaken activity later, it's easy to say I'm going to look through that and cut. But in practice, I think it's hard. So Matt, actually, at this point, though, I think I would actually kind of ask you the same question, but in a different way, right? We doubt the Fed may be able to do this, but the market priced in more rate cuts this year than we think is likely. How would you explain the market pricing and how far away from my expectation do you think it could run?
What's really interesting about how the market has priced the recent events is it's actually pricing more in line with the spirit of your view, in the sense that the market has priced more rate cuts in 2026 than it's pricing in 2025. So in spirit, the market is very much with you. But as we like to say, the market price is an average of all possible outcomes. And if one of the outcomes is the Fed does nothing for the foreseeable future, and the other outcome is the Fed cuts aggressively this year, then the market price has to reflect some degree of additional easing in 2025 that wouldn't necessarily be aligned with a rational baseline for Fed policy. So the market in some ways is reflecting the idea that you're proposing in your forecast, but it's also reflecting the idea that it's a market and that it has to be priced for some amount of risk premia that that the Fed is ultimately forced to cut rates more. And in fact, if I can ask you a question relating to that, Mike, the equity market at one point last week had fallen about 10% from the highs. Number one, is there a percentage drawdown that gets the Fed's attention? How does the Fed think about the equity market in an environment like this?
Yeah, I think the equity market, in my view, and I think the view of the Fed, is what I'll call a key spillover channel. Trade and manufacturing are relatively small shares of the economy. So if we pursue restrictive trade policies, growth should slow, inflation may be firm. That's the Fed's essential baseline. It's ours. The risk here, though, is that somewhere in there you get a destabilizing period, equity markets fall, upper income consumers take a step back, and you have a much broader downturn at that point. So you ask a great question. How far do equity markets have to fall? Well, we get 10% declines in equity markets on average about once a year. So it's not that. And the theory would say households have to view that decline in wealth as permanent, right? So it has to be a fairly substantial decline. Given how far wealth has risen, we're over $51 trillion now in an increase in net wealth since COVID. I think that decline has to be large. I would pencil in something, probably need about a 30% decline in equity markets before maybe that spillover risk gets very elevated. So Matt, if I can turn back, because I think we're in general agreement here on what we heard yesterday, but what I'd like to do in terms of looking forward, so aside from the usual communications coming from the Fed after the blackout period following the meeting, what do you think investors will be focusing on over the next month?
My sense is that there is already an unusual amount of focus on April 2nd. That is the day when the Trump administration is supposed to unveil their plan for reciprocal tariffs. It's unclear what tariffs will be implemented on April 2nd, what tariffs will be saved for a negotiating process thereafter. So clients are very focused on April 2nd. I also suspect that at some various periods between now and then, we are likely to receive previews in the form of various communications coming from the Trump administration on the types of policies that we may end up seeing delivered on April 2nd. And so I suspect that between now and then, there will be a crescendo in concern, perhaps, over what will come of U.S. trade policy for the balance of this year and really for the balance of the next 3.5 years. So with that, Michael, thanks for taking the time to talk.
Great speaking with you, Matt.
And thanks for listening. If you enjoy Thoughts on the Market, please leave us a review wherever you listen and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.